and welcome to COVID-19 Impact on Impairment Testing Valuation webinar. My name is Max Fonarov. I'm a founder and Chief Fair Value Officer at Sorbus Advisors. Our firm specializes in valuations that support financial reporting, tax compliance, and transaction planning. In the context of M&A transactions, we assist companies with their full life cycle. We start working with our clients when they plan to make an acquisition. So we assist with pre-deal deal pricing. We help companies assess their earnout provisions and prospective purchase price allocations. Then at the core of the solution, we do the full scope purchase price allocation analysis, including all the assets and liabilities that might have to be valued there. And we stay with the companies to continue and help them with impairment studies and mark-to-market valuations. A lot of our work is done in the technology-based industries, so work with information technology, life science, e-commerce companies. We do a lot of work with business product and service providers and financial institutions. In a spare time, we maintain a free-to-use database that helps visualize purchase price allocations through benchmarking comparable transactions. And you can find this database at bench805.com. In this webinar, we will talk about, we'll start with just briefly touching upon purchase accounting and then go into impairment. We'll talk about impairment triggers, impairment testing workflow. We'll discuss natural valuation methodologies that are used and how they're used in the context of goodwill impairment. We'll talk about how COVID-19 affects this analysis, how it affects the financial forecast, and finally we end with discussing market approach and control premiums. So purchase accounting is the process that helps companies record acquisitions on their books. In the process of purchase accounting, an acquirer doesn't just record the assets and liabilities of the entity that was acquired, but also new assets and liabilities are being created. Predominantly and most significant addition to the balance sheet of the acquirer are the intangible assets and goodwill as a result of the purchase accounting. The intangible assets could be long-lived assets or assets with indefinite lives. Also, contingent consideration as a liability may end up being added to the books as a result of purchase accounting. And of course, other elements are being fair valued, and those are inventory, fixed assets, deferred revenue, so many things, non-operating assets or holdings of other investments. The fair value is really the core of purchase accounting process. Now, the impairment testing is a process of keeping those entries up to date. And so specifically, goodwill and long-lived assets, indefinite-lived assets are being tested for impairment. Typically, the test is done periodically, and the companies would elect the date annually that they would run the impairment as of. However, upon certain triggers, this testing can be accelerated. And so essentially, in NSC 350, that really governs how the impairment testing is performed for goodwill and for assets with indefinite lives. It states that entity may assess qualitative factors to determine whether it is more likely than not that the fair value of reporting unit is less than the carrying amount. Now, it lists a number of triggers, but at the high level, it really breaks down to macroeconomic conditions. It talks about the industry market-specific factors. It talks about overall operating performance of that reporting unit, or I should say entity that's being tested for impairment. Any specific events such as change in senior management or what have you. And for public companies or reporting units that are part of certain public companies, the decreasing share price of those public companies a lot of times leads to the discussions around impairment, and potentially starting at least at the qualitative level to look at the impairment testing. Naturally, COVID-19 crisis is the trigger here. It's probably safe to say that microeconomic conditions are such that the companies at the very least have to visit with certain qualitative considerations and really assess whether the current conditions substantially changed their outlook for the impairment. Now, this is the chart, and it really gives the graphical representation of what have happened. And let me move myself out of here a little bit. Yeah, so what happened on the market in the last 4 months or so. You'll see different indices and how they changed since last year. Interestingly, at the very top, NASDAQ, it's technology heavy index, barely budged since last year. And so if you skip the middle part here, you might think that nothing really have happened. At the same time, if you look at the Russell 2000, then that index at the end of, this is end of April data, still remains at negative 20% relative to 12/31/19, and it dropped as far as negative 40%. So these type of market gyrations are definitely indications of something significant happening out there, even though we hear that many pundits sort of comment on stock price not reflecting the full extent of economic crisis that I want to say approaching, but probably still don't know where it's going to end. So let's get down to kind of nuts and bolts of the process. And so let's say we determine that there's a triggering event out there that would require us to start thinking about impairment, you know, setting that meeting with your finance folks and discussing that maybe briefly, maybe at length. For goodwill impairment, the test is relatively straightforward. So the entity has to value its business, its equity, and compare the value of the equity to the value or to the carrying value of the business, or book value of equity. And again, it's important here to make a distinction that we're valuing equity, we're not valuing the whole business. There are several definitions of, or several levels at which you can value business operations, and equity is obviously part of overall value of the enterprise. The overall enterprise value or business enterprise value would also include debt. Anyways, the fair value of the equity is determined, and if that fair value is below book value, then we have an impairment. So if we have an impairment, then the impairment loss, the amount of loss, is really the amount of difference between fair value and book value of equity. So that is actually pretty straightforward. But there are other parts to consider. So probably not very relevant to current condition and situation, but upon negative triggers, we may not necessarily be considering step 0. Step 0 is allowed in goodwill impairment, where the entity is very clearly, without a doubt, performing well, and valuation has not dropped. So step 0 is also has to satisfy that more likely than not. So a 50% chance that it's not, it's not valued below its book value. But in reality, step 0 is really the compilation of qualitative factors that management presents to argue that the value of the business is okay. Now, every time we use qualitative factors to argue really a quantitative point here, then the factors have to be overwhelmingly positive, because otherwise different stakeholders have different interpretations for this quote-unquote qualitative factors. And so management has to be careful not to try to go down this road, which appears to be simple, but it may be anything but if you get in discussions with your auditors about what is what in the qualitative analysis. But at the same time, many situations are such that companies are clearly doing well, or their fair values are clearly far above their book value, and in that case, there is no need to do the business valuation analysis. Now, goodwill impairment testing a lot of times does not exist in isolation. In purchase accounting, we record goodwill, but we also record long-lived assets or indefinite-lived assets. And so these are the assets that would actually very often be affected just as well as goodwill by negative developments in the company. As a matter of fact, if you think about something like customer relationships are a reflection of how well your customers are buying your product. And so if the business is not doing well, chances are customers are not buying. In other words, if a company does have significant assets on the books at the time of the triggering event, then at the same time it might be useful or prudent, or probably a requirement, to consider asset impairment at the same time. The asset impairment also starts with qualitative test, and so with that it kind of overlaps with the goodwill qualitative analysis. And as I mentioned earlier, every time we use a qualitative factors to argue a quantitative point, we have to be really sure that it works. But not only we have to consider asset impairment, many times we have to consider that ahead of the goodwill impairment test. And that's because if assets are impaired, then they have to be impaired first on the balance sheet, so that the carrying value, the book value of equity, is affected as well, or written down. So in fact, you have to really make sure that you're working with the right book value of equity before you get into testing goodwill for impairment. And so therefore, many of times you would actually be looking at doing asset impairment testing before doing the goodwill impairment testing. Now, a little bit of regulatory references here. In US GAAP, impairment testing is covered by Accounting Standard Codification Topic 350. So that's for goodwill and for assets with indefinite life. So for example, IPR&D, or maybe trade names that are indefinite life. ASC 360 covers impairment testing for long-lived assets, and those are intangible assets, could be, or those could be tangible assets as well. Under IFRS, International Accounting Standards 36 covers both types of impairments. Now, another difference and thing to note here is that goodwill testing or impairment testing here is not done at the acquisition level. In other words, if you purchase the company and that purchase tanked, you don't necessarily have impairment on your hands, because in US GAAP, you have to test goodwill at the reporting unit level. So you may imagine a lot of publicly traded companies that are not huge, let's say, they are just a single reporting unit. And if they make a small acquisition and it doesn't work out as well, the whole company may still be doing well. And so if the whole company is doing well, then no goodwill impairment testing is required, even if all of that goodwill came from that bad acquisition. For IFRS, the definition is slightly different. It's not the reporting unit, it's a cash generating unit. And so a lot of times it's also aligned with kind of the business operation or the business unit that performs those operations. And again, the acquisition may not be substantial relative to that cash generating unit. And so the impairment itself is not assured. But at the same time, when you're looking at individual assets, specifically individual intangible assets acquired, those do remain to be acquisition specific. And so while the goodwill impairment can shield itself by fortunes of the larger reporting unit, sometimes the assets may not. Another point to note is for private companies. So the private companies may elect to amortize goodwill over a 10-year period of time. So first of all, a private company means the company that never, ever will ever go public. Otherwise, this election is highly discouraged. 10-year period of time is a completely arbitrary number, selected by FASB, and but this is something that companies can do. Now, if the private company made that election, it does not change the process of goodwill impairment or asset impairment in any kind of way, except for, of course, every year you're dealing with a smaller amount of goodwill, and so your book value of equity is going down, and so the impairment testing should be easier to pass. But again, just because qualitatively we know that it should be easier to pass, quantitatively we may still have to prove that point, unless again we're really far ahead of book value of equity in that case. For private companies, a lot of times we can use other valuations that the company performed, and if those other valuations indicate that the value of the entity is much greater than its carrying value, then that would probably still fall under step 0, qualitative test, because the analysis is not done specifically for goodwill impairment purposes, and very likely did not follow the process that's required there. But at the same time, if indications are that we have a lot of headroom, then that could be used in the qualitative analysis. Now, another point, if it's been a while since you've done goodwill impairment tests, say if it's been at least 3 years, then you might be pleasantly surprised to find that goodwill impairment test does not contain so-called step 2 anymore. In the past, step 1 was this comparison of fair value to book value of equity, whereas step 2 was the process of hypothetical purchase price allocation. So if you fail step 1, step 2 would require you to calculate goodwill amount precisely and then use that goodwill amount for setting the new amount of goodwill on the books and calculating the impairment charge. Huge process. FASB absolutely correct in eliminating that step 1. It wasn't actually the process under IFRS, and so it certainly made sense to simplify the process that way. And the final point here, and as we're getting on the next slide more into how we perform the analysis, very important when you do the goodwill impairment analysis, and it's essentially fair value analysis, you have to make sure that the financial information that's provided to the valuation specialist is really well fleshed out in terms of being clearly and fully attributable to that reporting unit. So if you have a large company with several reporting units, that you would have to make a very careful allocations on the balance sheet, intercompany transactions, debt, interest-bearing debt especially, as well as the forecast would have to be fully burdened with all the corporate overheads. So let's talk about valuation methodologies. Again, the fair value here is the king, and it determines how the financial analysis, how this test is done. The fair value definition is essentially the same, except for a couple commas there between IFRS and US GAAP, but it's the price that would be received to sell an asset or paid to transfer a liability in orderly transaction between market participant the measurement date. So the key here to note is that fair value is really the way we would look at value on a really orderly transaction basis. In other words, it's not any kind of fire sale. It's not any kind of opportunistic transfer of equity stake. It's not any kind of special situation. It's really, in many ways, you might think about it as a you know, really a good fundamental view of the value of the business. And so with that, if we go back and if you think back to the charts that I showed earlier about different indices, it would probably be inappropriate to pick, you know, end of March, or say March 23rd, I believe was the date of the lowest level of index prices there. It would be inappropriate to find a date that would be kind of sitting in the middle of that high volatility. And if you do end up dealing with the valuation date that sits in the middle of some volatility, then you have to deal with it, because it would likely not be representative of that long-term view of the company value. Now, in the long-lived assets impairment testing, there are two steps, and they're a little surprising if you haven't seen it before. So the step one is where we take the financial forecast. So we have to develop the financial forecast pertinent to that particular asset. So for example, we had customer relationships as part of the purchase price allocation. So we have to develop the forecast that would be reflective of the operations, or that would be attributable to those customer relationships. We take that forecast and we calculate the cash flows that that asset can generate, and we take the total of those cash flows without discounting, and the key here is without discounting. So we take that total and we compare that total to the carrying value of that asset. So you would also note that the asset is typically has typically been amortized as well. So if we're 2 or 3 or 4 years past acquisition, then the asset is certainly not at its original fair value. So we are already dealing with the low value of the asset. But also the asset initially is recorded on the balance sheet on the fair value basis, which is discounted cash flows. Now, for the purposes of the impairment testing, we're comparing it to the undiscounted cash flow. So really, there is a lot of headroom being created here in this rule that would shield a lot of assets from being impaired. Now, if you do end up not being able to pass step 1, step 2 will definitely be pretty brutal, because on the step 2, you have to go back to that forecast and discount those cash flows, and use those discounted cash flows to calculate the amount of impairment charge. So you can imagine that if you miss the mark on the undiscounted basis, then if you discount those cash flows, the difference will be even greater. So this is a long-lived assets, and again, you have to do that. If you have to do that, it has to be done before the goodwill impairment test. Now, the goodwill impairment test, as I mentioned before, it's essentially the fair value of equity analysis. And here we use a typical traditional valuation approaches. So it's the income approach, market approach, asset approach. Asset approach, probably shouldn't talk about it here. It's very rare to see it, if ever. But the income approach and market approach, the very important point here to keep in mind is that these valuations are done from the market participant standpoint, which is different from the value of the equity on a standalone basis. Now, in this valuation analysis, we essentially have to estimate what would be the value, or what would the typical market participant pay for the value of the entity. So again, it's not a standalone entity, but it's the price that somebody would pay there to acquire your company. And so in the income approach, this can be reflected in the financial forecast. First, the financial forecast that would include certain level of synergies, for example, that the acquirer would want to pay for. And it would also have to consider esoterically, so I believe is the taxable transaction characteristics. So there would be certain consideration given as to how would you expect this transaction to close for tax purposes, what the structure would be, and depending on that, there would be an additional tax amortization benefit added to the value of the company. So those are actually relatively, unexpected changes, and so it's there. You see, it's not just a simple business valuation, but there are some things to be done there to adjust the analysis for the goodwill impairment purpose. The second point here to make on the market approach basis, market approach is essentially a process of finding and determining the market valuation market multiples, and then applying those market multiples to your subject entity. Now, you can determine those multiples based on the publicly traded companies, peers, and you can determine those multiples based on guideline transactions. So the guideline transactions are actually the places where the market multiples would be consistent with the notion of, how much market participant would pay, because those are the prices observed as a result of such transaction. For guideline publicly traded companies, those multiples are calculated based on market capitalizations of the publicly traded companies, and those are clearly the minority stakes in those companies. And so therefore the values or those multiples would not be consistent with what you would expect the value should be for the company when it's being acquired. Now, let's talk about kind of the mechanics of how you would put the financial forecast together, how you would look at it, and how it's affected by the current environment. So obviously, financial forecast, market multiples, cost of capital will all be affected by the current environment. And so if you start changing those things and rewriting your valuation as of, say, March 31st, then you would see results that would be significantly different, should be significantly different from the last year. Financial forecast, when you build a financial forecast for the goodwill impairment purposes, you would typically start with standalone forecast, because that's most intuitive for management to develop, because they know how their company operates and they can project, and with a certain level of confidence or precision or what have you, how the company would perform in the future under normal circumstances, at least. The second step would be to add the market participant synergies. And so we understand synergy, right? So, but the good place to start here is to really determine who those market participants are. Depending on what industry you work with or what's happening with what the M&A market looks like for your particular sector, you may find that a lot of acquirers, a lot of transactions are happening, for example, with private equity firms, where you would expect very little synergy. Or you might see that your competitors or your peers are being acquired by strategic acquirers. In that case, you would see a relatively more synergy in the forecast. And so based on your understanding of the market and the analysis of those market participants, you can start speculating as to what kind of synergy you might expect. Obviously, it's a highly subjective exercise, but again, as always, the more analysis and the more detail you put into that, the better it is and more auditable the process is. The synergies can be found at the revenue level, at the cost level, at the capital expenditure level, at cost of capital level. So there are all sorts of ways that when companies join together, they can benefit if the execution is right on the integration of those acquisitions. But so that will be the second key step. Now, when you're developing the financial forecast in the current environment, obviously it would be helpful to look at what economists are predicting would be happening to the economy going forward. And so the chart here to the top right shows the few scenarios that the conference board, the economic board here, projects for the economy. It should be noted that this was beginning of April, and chart has not been revised as of yesterday. Another way to reflect the current situations is to really start thinking about the scenarios. Generally, my firm advises clients not to go down to into the rabbit hole of many scenarios, because the analysis starts becoming impossible to comprehend. There's just too many numbers, too many moving parts, and it becomes overwhelming. It doesn't tell the story anymore. It's just a pile of numbers, so to speak. But it may be useful to, in current environment, to think about at least two scenarios. One scenario is where it's modestly optimistic recovery scenario from the current financial crisis, and the second scenario is where things are bad and they stay bad for a while. So kind of splitting the future or the forecast into those two very distinct and binary outcomes might be helpful. It's better to deal with these scenarios than just simply adjusting the cost of capital, because cost of capital is, no matter how you calculate it, it's a highly subjective number. And a lot of times it just doesn't tell you any story other than things are risky or things are more volatile on the market. Okay, so we know intuitively that things are risky, but how much more risky? And so if you're actually dealing with a steady cost of capital, but then you're introducing those negative scenarios, the negative scenario may tell the story much better as far as why the valuation went down and how the valuation will recover over time as you hopefully phasing out that negative scenario and adjusting the positive outcomes as well. Now, the good financial forecast, there are many characteristics of the good financial forecast that you can test before you send it to your friendly neighborhood valuation specialist. First of all, if you test assets for impairment or goodwill for that matter, comparing the forecast to the purchase price allocation forecast could be very informative. Or simply comparing that forecast to the last year's impairment study. It's something that absolutely has to be done to kind of have a perspective as to how things changed. Now, putting those comparisons aside, the good financial forecast would always show you the detail behind why things the way they are. So it would be transparent as to the volume, the price of the product, the market share, the cost structure, things of that nature. So these headcounters, a lot of companies now reducing the workforce, but hoping to bring those people back. So these types of details could be very helpful in telling the story about what's happening with the business. It's not a mechanical process. There's no software that's going to replace this level of work. It always pays off when you have discussions with auditors, but also when you have discussions with senior management, the boards, and when you're using this work as a reference next year. Now, the good financial forecast is also evidence-based. So you can look at the overall economic forecast as presented on the slide. You can look at syndicated industry research reports that would be updated for the current conditions. But the more third-party information you can use, the better you can support that financial forecast. And then the last thing I note here is that very often we get financial forecasts with extremely high profit ratios. So, anything above 40 or 50% EBIT margin is a suspect. And the reason for that is because those forecasts very often they skip over very important expenses. So a lot of times they take sort of like the product forecast view of the future, and they ignore either the R&D or sales and marketing expenses or investments that are required to build the product the way the forecast is going, or they don't have proper overheads and allocations of the greater entity. In other words, let somebody else pay that lease, which is going to sell the product, and the forecast becomes a purely cash contribution forecast as opposed to the full-in economic P&L forecast. And it's the latter that we're looking for in this analysis. Now, for market approach, so market approach is another way, right? And so we touched briefly upon it. The market approach is the process of developing those market multiples and then applying them to the current financials of the company. Now, in the current situation, typically when you have a significant reset in economic environment, the forward-looking multiples are the multiples that are preferred over the trailing multiples. So as opposed to multiples that rely on, say, last year's revenues or last year's profitabilities. It's the forward-looking multiples that are more interesting or more telling in this analysis. Then in the market volatility situations, again, we don't want, when you calculate the market multiple, you need to take a point estimate of it. And so if you think about the publicly traded company, you look at the market capitalization of that company, but that's always a point in time number. It's, it's a stock price times number of shares, and the stock price changes every second. So the more volatility on the market you have there, the more likely you would end up with the market multiple that's not really representative of that more longer view of the business as was discussed in the fair value definition. And so, again, depending where your next valuation date falls, you may want to consider average multiples as opposed to looking at the multiples of a point estimate, time, and place. Now, in market approach, also important to look at the peers. The common mistake we find there is clients are too focused on their competitors, and that's very natural and very understandable. But for the purposes of this analysis, the company that competes with you may be not a good comparable company for the purposes of the valuation analysis. So for example, if you're a small software company with one product that tries to break through out there, and you find that you're competing with Oracle, for example, Oracle is not going to be a good comparable company because Oracle is a country. It's a huge enterprise that fully diversified with many business lines and such. And so when you look at the risks and economic exposures of something like Oracle, while certain things will correlate with your business, but in reality, your fortunes will diverge in very significant ways from those of the big peer competitors like that. And so it's more important to actually think about economic factors that affect you as a business. So, what's your customer concentration looks like? What is your product on the market? What areas are you exposed to? What geographic areas are you exposed to? What recent investments you made that may or may not be in question now? So, and for that, the smaller the company's size, a lot of times is the better indication of whether the company is comparable or not. So again, don't rush to list the number of competitors. Think about the companies that you can really sort of, go have a coffee with those executives and complain about your life and understand each other. So those are the types of companies you need. Now, guideline transactions are also tricky in the down market because guideline transactions, they're never as of the valuation date. It's always some kind of date in the past. So if you have a transaction of one of your peers that was acquired, say, in the bull market of 2019 or 2018, those multiples may not be applicable for the current situation because there's so much uncertainty. And so it's because those guideline transactions, while they in principle more consistent with the valuation that we need, the valuation of the market participant, we commonly find that those guideline transactions may not be easily applicable in the current environment. So the very important element of the market approach, actually, we talked about how the guideline publicly traded companies will give you multiples that are not consistent with the market participant price that would be paid for that company. Very often we hear that, you know, the publicly traded company being acquired by somebody and they paid, you know, say 20% premium or 40% premium to their trading stock price. So that's commonly in the news. And so this is really market participant acquisition premium is that. So it's really the difference between what would somebody pay for the company and what was the trading price of the shares. Now, if we have to adjust for that. And so market participant acquisition premium, it's more commonly known as a control premium, but it was renamed into market participant acquisition premium because control premium does not tell the whole story. As a matter of fact, SEC expressed the opinion that control is rare, and if anything, it's relatively small when you talk about large companies changing hands. But the majority of the impact that leads to that type of acquisition premium is really the synergistic premiums, and when acquirers are finding points of connection with the company that they acquire where they can save money or they can sell more product or what have you. In other words, the price is increased because bidders are increasing the price because they all commonly see some level of synergy there. And it's, by the way, it has to be that market participant acquisition premium. It's not a specific acquirer acquisition premium. So it's not the process of finding the potential acquirer who will give you the biggest bang for your buck. It has to be something that you could expect from any random company that calls you with LOI. So market participant acquisition premium can be very important, because you can imagine that for a publicly traded company, the publicly traded company may have a market capitalization that's actually below its book value, but it may still pass the goodwill impairment test after you added that market participant acquisition premium. So if the company is trading for $10 a share, you might expect it to be acquired for, say, $14 a share. And so $10 a share doesn't get you over the threshold, but $14 a share will. So those situations are, this can be common, and this can certainly be the case, and you can certainly pass the nothing says that goodwill impairment test cannot be passed with the help of market participant acquisition premium. However, you can surely expect a lot more scrutiny from your auditors when you are relying on market participant acquisition premium to pass the test. At the same time, some companies use these types of financial or economic crises to get rid of goodwill completely. So they would say that, hey, we clearly impaired, things are definitely bad, and our fair value is so low right now that the difference between the difference between book value and fair value is so big that you can completely wipe off the goodwill off the books. Now, that has been also done, but that also ignites more scrutiny from auditors, obviously, in these types of situations. And in these types of situations, I mean, you might still have to be using market participant acquisition premium, but in that case, you'd be motivated to kind of using the lower end of that range. And so in both situations, you would have to be prepared to kind of talk to your auditors. A lot of times we find that some auditors take a very conservative approach to goodwill impairment, and even if you pass without any kind of market participant acquisition premium calculation, a lot of times they would test the sensitivity of different assumptions, not necessarily saying that your assumptions are wrong, but saying that, hey, if you change this a little bit, then you fail. And so the companies have to be very careful when you approach the goodwill impairment testing discussion with their auditors, especially if you're pretty close to that carrying value of equity. And so to summarize this discussion, kind of the key takeaway points is that current macroeconomic conditions should at least create one meeting, one discussion within the company about whether the goodwill impairment testing or long-lived asset impairment is present or not. When you think about goodwill impairment, other assets should be considered as well as potentially impaired and potentially impaired before the goodwill impairment testing takes place. The valuation analysis must be performed from the market participant perspective, so it's not a standalone company perspective. A lot of tax valuations are actually on a standalone basis, and so in that they would not be consistent with the market participant analysis. And finally, market participant acquisition premium or control premium. Again, people will use control premium a lot more frequently as a term here, but market participant acquisition premium can be a small part of your report, just a couple exhibits, but it will create a lot of discussion, may create a lot of discussion with the auditors. So with that, I stop the presentation and ask for, solicit for questions. Okay, so the first question is whether the stock price is always a representative of fair value. So there was a lot of discussion around that point, and there's a lot of views. I mean, obviously, the whole asset management industry of active managers believes that the fair value is not the trading value of the stock. But in financial reporting, the trading stock is the king. And so even if it's not the best indication of, even if it's not the exact indication of fair value, it's the best indication of fair value, just because the valuation methodologies are not that precise. There are many theories that fly around, so people talk about the asymmetry of information. People also talk about the supply and demand nature of shares traded on public markets. In other words, the equity share is becoming more of a commodity, moving with supply and demand more than they move with the fundamentals of these companies. Certainly you can try to argue that the company, the trading prices of the company don't reflect the true economic value of the company. It's typically hard with auditors, and by hard, I mean they essentially not going to accept this argument most of the time, and you would have to have some qualitative analyses done, but again, your DCF model is not going to override the market capitalization of that company. So what's the triggering event for private companies? I briefly mentioned that the tax valuations can be used in the qualitative analysis, and so that could be the case. But so we also do a lot of work in the 490 valuation world, and so a lot of companies are now rushing towards trying to get that stock option price go low. Now management has to be careful with that, because if you do have a lot of intangible assets on the books, a lot of goodwill on the books, you have to make sure that this 490 analysis will not lead you down the line of goodwill impairment. However, in the private company, management can be a lot less sensitive to this type of impairment charges. Having said that, again, the 490 analysis is done on a standalone basis, and so for a goodwill impairment, you would in theory be using different multiples and different financial forecasts. So there's more opportunity to pass the test, pass the goodwill impairment test, while keeping that stock price low. Again, a lot of analysis and work with the forecast and with multiples and comparable companies that auditors would definitely take it to the task. But that's what the fun is all about. And I'll answer the last question. So what if the company had LOI last year that didn't go through? How you would use that information? So Valuation analysis, in many ways, you can think about it as a research. As a research, that tries to find the answer to that question, what the company is really worth right now. And so LOI can be very telling and indicative price. So if you're talking about the publicly traded companies and you had an LOI at a certain point in time last year, then you can actually infer that market participant acquisition premium from that LOI. For private companies, that also sets the stage, and so you can infer the multiples from that analysis, and then kind of trend those multiples down to the current point in time. But LOIs, even though quite a few of them fall through, unfortunately, we do see them as a great indication of value if it's an official sort of offer to buy, not just a verbal water cool discussion, so to speak. So with that, I'll stop the presentation, and I'll welcome you to certainly reach me directly over the email or LinkedIn, however you find most convenient. I'd be always happy to chat and answer any other questions. Thank you very much.